series of workshops that we're gonna be do. So let me share the PowerPoint first and start right away. Oh, okay, so today it's the second lecture in our series of workshops. It's gonna be on process. Okay, I'm gonna present it along with Aaron. Okay, so we're gonna talk, as I said, about orders and prices, and we're gonna see how much this topic is important, and we're gonna see its importance now. So here are the topics. First, we're gonna cover orders to buy and sell. Then shares outstanding and float by Aaron. Then we're gonna talk about what makes prices move, and this is basically like the target of today's workshop. This is the main thing that we today to you guys, because if you understand this, this is the first step of being a professional trader. If you don't know this, what makes prices move, okay, you will never be a profitable trader. Okay, so this is very important, and the whole workshop today is dedicated to this important topic. And then we're gonna talk about brokers and platforms, because we got a recommendation of, and at the end of the workshop, we're gonna give you an Excel sheet which have we're gonna see it. Okay, let's start right away. Buy orders to buy and sell. So what's an order basically? An order is an instruction to buy or sell a trading venue such as a stock, a bond, a commodity, a financial derivative, or cryptocurrency exchange. Okay, this is an instruction to either the trading venue via direct market access. So what do I mean by that? Last time we learned that we have buy, selling, and all of this. Okay, and we know that in order to buy, sell, short, anything, we have to contact our broker and tell him basically what do we want. Okay, but how can we do that? Okay, it's through an order. So this is basically the shape of an order. It's simply this thing over here. So this order is sent to the broker, okay, and he'll gonna do your order. So let's see from what it consists. Okay, so first we have the ticker, which we explained it. It's abbreviation of company desired to buy or sell shares with. So I want to buy shares of company Apple, for example. The ticker for Apple company is AAPL. Okay, so it's a small abbreviation in order for the broker to know what company you want to buy, sell in. Okay, for example, another example is Tesla, TSLA. Now it's important also to put the want to buy or you either want to sell. The type of order, we have market order and we have limit order. About these, basically specify the price. Okay, so it's basically the difference is market order, you don't specify the price. Limit order, you put the price that you want. Quantity, the number of shares you want to buy, you want to sell, you want to short. Okay. These are the types of orders that we mentioned in the last slide. So market order is the stock at whatever price it is trading at. So it's like basically telling the broker, listen, I want this stock, I want it now, right away. Whatever the price is, I don't care. I want to buy it or I want to sell it at this price, at this moment's price. Limit order is that you specify the price that you want to sell at. So you tell the broker, listen, when the Apple stock drops to $100, I want you to buy. Okay, so what does he do? He automatically buys for you because you put a limit order $100. So when the price touches $100, he's gonna buy for you automatically. Okay, so you may be sleeping, not trading, not in front of your laptop trading. You may be away, and the broker will automatically buy for you. Now, market on up, market or on close is the buy sell directly when the market opens or closes. Okay, so as you know, guys, the market opens at 4:30 p.m. in time. Okay, if we put a market on open, that means on directly when the market open, I want you to buy. Now, limit order on open and close, it's basically the same, but here you specify a price. Now, why here you specify a price? Like both of them are on open or on close. The difference is that sometimes something called slippage happens. So you want to like buy at $100, but suddenly the price drops to 99.5. If it's or even if it's 99.5, you're gonna sell or a limit order, on the other hand, no. Like you put $100, if it's different than $100, it's gonna stop. He won't buy or sell for you. And as we can use it on open, we can use it at close. We know that the stock market closes at 11 p.m. in our timing. Okay, in the Easter timing, which is New York, it's from 9:30 to 4. Other two types of that are basically limit orders. We have a take profit. It's a limit to take profit when prices hits a desired level. So let's say I bought an Apple stock at $100. I take profit at 110. So what does that mean? That tells the broker, listen, when the price hits $110, you sell for me and take the profit. Okay. Another type is stop loss. It's also a limit order used to stop losses when prices falls to a specified level. Okay, so let's take also the example of Apple, which is dollars. You tell the broker, listen, I want to put a stop loss at $90, which means when the $90, he's gonna take your loss. So he's gonna sell your shares, and you took a loss of $10 per share. And if it dropped more, you won't have more losses, okay, because you already sold. And also the importance of these two is that you may be also away. You may not be trading or on your computer trading. Now this is the order window on internet brokers, specifically on their platform, which is TWS Trading Workstation, which is the platform of interactive brokers. So this is basically the order window. What do I mean? So when I want to sell an order, what I do is I come to this order window over here. As you see, there is here MSFT. This is Microsoft. This is the ticker of Microsoft. So in here, you can type any ticker you want. So let's say Apple, Tesla, anything. You type the ticker here. Then you specify the side, either to buy or to sell. As we talked before in a slide, we talked about like you have a ticker, you have the side, and here is the side. Is either you buy or you sell. Now here is the quantity. How many shares I want? 1,000 shares, 200 shares, 1 share. Okay. And here is, as you see, it's limit. Okay. It can be market order. So you click and change it to market, MKT. It's market order, the type of order that we discussed earlier. And you can also, if you click over here, you can specify profit taker. So take profit and stop loss. So a limit at this price, a limit at this price. And here, as we said, a limit, you have to specify the price. So when you put a limit, you will specify the price of the limit order that you want, and you click submit when you finish. Or if it's a market order, this will disappear and it's gonna basically a market order. So whatever the price is, you're gonna buy or sell. And you click submit and you're ready to go. And something here is also very important. This shortable over here, if it's colored green, then you can short this stock. If it's not lit on, you can't short. Okay. So this was my part for now. I will also be talking about what makes prices moves. Now Aaron will explain for you the shares outstanding and float.
Yeah, so thank you so much, Marwan. I'll be explaining now. Okay, so you have your shares outstanding and your float. These are words that you probably hear a lot. So first of all, just a quick review on what shares are. Shares basically like they represent the actual ownership of a company or whatever. The amount of shares you have correlates to how much of the company you own. Say you have like a company with 200 shares and you have 150, so you own 75% of the company. And they're also referred to a lot as stocks. You're going to hear the both words. They're pretty much identical. They don't matter. And shares, actually, this is a new thing. They can have various types and classes. Like not all shares are created equal. We'll get into that in a bit. First of all, you have your types of shares. You have your common stock and your preferred shares. The common stock is what Marwan and I commonly refer to. It's the shares that are traded on like these stock exchanges. They're public ones. And you have your preferred shares. So preferred shares are a different type of share. They're basically a mix between debt and equity, like we explained it last time. Debt is like when you go out take a loan from a bank, and equity is basically like the ownership. So preferred shares are like some sort of hybrid thing. And preferred shares of three types. You have your cumulative, non-cumulative, and convertibles. So cumulative is basically like whenever there's a dividend, I'll explain what the dividend is later. Basically, when a company like hands out money back to its shareholders, so it divides the profits to its owners. Cumulative means that every year they have a right to dividend. Non-cumulative means if a company skips paying for 1 year, say it doesn't have a lot of money or it didn't make enough money to actually pay, it needs the money in the business to like grow, it doesn't get counted. So it like resets every other year. And you have your convertible preferred shares. Convertible preferred shares are basically preferred shares that have an extra fee you can pay to actually turn them into common shares. So you basically get rid of the debt part and go straight into equity. It's a bit confusing, but you won't see a lot of preferred shares anyways traded because the prices don't really move. You know, it's basically like a sort of a bond, like a fixed income instrument most of the time. So some other companies have something called dual class or triple class share structures. Google's the most famous example. I think Facebook is one as well. It's basically this is done to protect yourself from hostile takeovers. So hostile takeovers are like a situation where I don't know, some other people want to buy out your company entirely and like remove you from management and they take control of them. So if you have like a dual class share structure, it's much harder to do this. Voting rights matter. So every company is basically like a country. They have like a meeting every 3 months. They have a yearly annual meeting. They have a lot of meetings and they take a lot of decisions. So some actually shares, remember how I said they're not all created equal? Some shares have like one voting right, others have 10. So if you have one share that's class A, which has 10 voting rights, and one share that's class B, which has one voting right, everyone who owns the A share can vote 10 times. You know, their votes are multiplied by 10, while B is multiplied by 1, and things like that. So it's proportional. And it protects the original owners. So Facebook's the most famous example. Zuckerberg never wanted to lose more of control of his company. So he has 52%, I think, of the voting rights, but he has only 20% of the company in total. So he doesn't have most of the company, but he has most of the voting rights. So he controls like the company's policies and politics. So Class A and Class C shares for Google, they're the publicly traded ones. They're pretty much identical, like you can see from the chart. It's literally identical. I'll just show you with the laser pointer right here. It goes up, it goes down. The prices are pretty much the same. It moves the same amount almost every day and things like that. So they're pretty much identical, like money-wise, but they have different voting records. That's all. Shares outstanding and float. This is the title of the chapter that I was actually going to be explaining to you. So shares outstanding basically represents the total amount of shares issued by the company. So companies can have the right to issue 1,000 shares, but if they've only issued 900, that means they've only made available 900 shares. That's your shares outstanding. Your share float is the amount of shares that actually are readily traded on the market that are available to be traded. So even of those 900 shares, sometimes the company likes to keep 200 in its own account. That's called treasury shares. So only 700 is floating. Floating basically means like, you know, it's being traded on the market. So here's a quick example just to explain that in numbers. So company X has 100 shares outstanding and 75 shares floating. That means only 75 shares are actually readily available on brokerages and can be traded by you and I, while the other 25 are kept either by like private investors or by the company itself. So the company may keep 20 shares by itself. It belongs to the company basically. And then 75 shares are available to be traded on the public, and the rest is held by like a private investor or whatever. This is just an example. The numbers are completely different every time. So profits, whenever a company has profits, it has two major decisions. Each of them has its own advantages and disadvantages. You have your buybacks and distributing dividends. Buybacks and dividends, basically. So buybacks are something that have become very common nowadays. It's when a company basically goes back to the market and ends up buying its own shares. So it basically like lowers the float, if you will. The company, say it made $1 million, it goes ahead and uses some of that money to actually acquire its shares back from the market. So it's basically like dividing the pie, the piece of pie, into smaller parts, because now most of it is belonging to the company again. So the float is going less and less, which means supply is decreasing, which means price of the stock increases. It may also backfire sometimes, because a company that does a lot of share buybacks, some people might be like, oh, this company isn't doing a lot of profit, so instead it's buying back its shares. So it might have a negative like psychological effect, which may actually backfire and hurt it. And it also can be rejected and limited. So the Fed, like the Federal Reserve, which is the Central Bank of America, basically, it forced all banks to stop share buybacks for 2020. So they were not able to buy back a single share all of last year. So they don't have as much control on buybacks as they do dividends. Dividends are voted on by the company itself, so the board gets the vote. They're like, oh, we made $1 million. We're going to distribute 3% of that $1 million back to our shareholders. So 30% is an easier way. So $300,000 are distributed back to like the shareholders. Obviously, each share gets a proportional amount of the pie, whatever. And dividends are taxable. So here's the problem. Whereas like buybacks, when the share price goes up because there's less shares, the supply is decreasing, they don't actually charge you for that money. But whenever you get a dividend, you have to pay taxes on the dividend because it's sort of like income. And they're less actually effective than share buybacks, because dividend basically removes the cash from the company to the shareholders, while share buybacks basically removes the cash from the company, but not necessarily, because they're buying back their own shares. So their own ownership is actually going up proportionally. So these are two concepts that are very important, and you'll hear these thrown a lot around in the news. So my part is done, and I think it's back to Marwan. So Marwan, please get us started.
Okay, thank you a lot, Aaron, for this important information. So let's continue, guys. Okay. Now we reached this topic: what makes prices move? Okay, and as I said, this will be a very important. Okay, this will be very important topic. Aaron, can you? Okay. Uh, as I say, it will be a very important topic. If you understand this, you're gonna like take your first step in becoming a profitable trader. Okay, so let's go. Let's revisit the company X that was Aaron talking about. So consider again the company X, which have shares outstanding 100K and shares float 75K. For simplicity, let's assume that there is only 10 people living on Earth. Okay, just for simplicity of the example. Okay, now let me share another document in order. Okay. Okay. I believe that you can see the Excel sheet that is here. Okay. So as we said, now we're gonna see how the prices move and what causes the prices to move the stock market. So you look at the chart every day and you see the prices going up and down, up and down. So what actually makes these prices go up and down? Is it news? Is it something else other than news? And we're gonna now cover together. Okay, and this is very important. All your understanding or all your future research and learning about the stock market is based on this. So if you understand this, you're good to go. Okay, so let's start. As we said, we considered only 10 participants living on Earth, okay, and trading, okay. So, we were talking about company X, which have 75K short shares float, okay, which are the shares that can be traded on exchanges, okay. So as we see here, person one have 40K shares, okay. So he owned 40K shares. Person two, he owned 10K. Person three, 2, person 4, 0. Maybe someone didn't buy or didn't have a percentage. Person 5 again 2, 6, 5, 7, 1K. Person 8, 0K. Person 9, 10K, and person 10, 5K. Okay, so let's start. And here are the orders. Okay, as we said before, we talked about orders. Every person is sending his own order, and we're gonna explain them. Okay, and these are in increasing order of time. So person one sent this before person two. Person two sent this before again person two, but another order. We have level 2 and level 1. What are these? Okay. As you guys, or you will know now, that the stock market or the exchanges where you send your orders, it's based on the first come, first served. Okay. So let's say I want to buy a stock of Apple. You know, it's Apple is traded on Nasdaq exchange. So my order is sent to Nasdaq exchange. How can Nasdaq, for example, or New York exchange can organize these many orders? Now, in this case, there are only 10 people, but imagine in the real life, which is there is billions of people selling every day, sending every day, sorry, millions of orders. Okay, so they have algorithms which order them. Okay, so the level 2, or we call it the market depth, also another name, is basically a table which have the buying orders and the selling orders. And we're gonna talk about is a level 1. Okay, so let's say, let's start. Level 2, buying orders, selling orders. Person 1, he is sending an order to buy at $41, 3,000 shares. So is this a limit order or a market order? It's obvious that it's a limit order. Why? Because he's specifying the price that he wants. Okay, so in the table, the first come, first serve, it's $41 and 300 shares. Now, person 2 wanna buy at $39, 5,000 shares. So $39 over here, 5,000 shares. Now, a question, guys. Not always things work like this. Sometimes this order might be above this, but how? Okay, so these people here in this table want to buy, right? So imagine, guys, that you want to sell. If you want to sell, you're gonna sell first to the buyer who's gonna buy your stocks for $41 or for $39. Of course, you're gonna sell them to the 41 because he's gonna take it for more. So that's why in this table, the 41 comes above 39. But what about the first come, first served? Let's say if person 2 sent an order at $41 to buy, okay? So it's gonna be the order of person 1 above, okay? But in terms of prices, things may change. Now let's continue. Now person 2 also, he sent another order to sell now at $55, 5,000 shares, okay? And he sent another order to sell at $59, 5,000 shares. Now, as we see here, guys, the highest comes first in this table. Now here, is it the same or it's different? Let's analyze it. Here are the sellers. If you wanna buy, so these people want to sell. Now, if you want to buy, you're gonna buy from someone who's selling for 55 or for 59 you're gonna buy from the 55. So that's why it's an opposite here. The lowest one comes first. So the 55 first, then the $59 will come. Okay, 5,000 shares. Okay. Now person 3 want to sell at $52 now dollars with 2,000. Now 52 is less than these two, so these two will gonna go down, and we're gonna here have $52 and 2,000 shares. Now person 4, maybe he's not participating. Now let's see person, but that doesn't mean that it's because he doesn't have anything. He can buy, okay? He can short. Person 5, he wants to buy $50. So again, 50 is higher than these two. So this comes down, and it's $50 and 1,000 shares. Now here, guys, let's here analyze something. Now here, there is nothing bought and sold yet. Okay, there were no two people matching in order to sell. So if you look at the chart of this stock, you won't see anything. It's an empty chart. Now let's talk about the level 1. What is the level 1? It's basically a summary of the level 2. Okay, so the level 1 only shows you the best price to buy and the best price to sell. Okay, so basically here it's gonna be 50, 1,000, and on the other hand it's 52, 1,000. Okay, let's continue now, and I'm gonna talk later about something important for the level 1. So P5, it's here. Now P6, he want to buy at 48, 2,000 shares. So these two will come down, and 48 will be in the middle. $48, 2,000 shares. Okay, P7 want to sell now at 51, which is less than all of these. So it's gonna go down. And here 51, 1,000. I know, guys, this may be a little boring, but this is very important for your understanding. Now, P8, person 8 want to buy at $46. So it's gonna be between these two. $46, 5,000 shares. Okay. Now P9. P9 wants to sell $5,000, but he didn't specify a price. What does that mean? That means that he want his type of order is a market order. So he's gonna sell and he doesn't care about the price. Sell it right away, I don't care. Okay. So what he's gonna do is that he'll sell 5,000 shares at any price. Okay. And because he is a seller, he's gonna sell his shares to a buyer, right? So he's gonna come and look at here. So at $50, there is 100 shares. Okay, so this will be gone. Why? Because he wants 5,000. So he's gonna sell this person 1,000, and this person is done. Now he still needs 4,000. Okay, he's gonna come here and sell for this one at 48. He's gonna sell him 2,000, but it's not the end. He still needs 2,000 more. So this one 46. We're gonna take from him 2,000 shares. So it will remain $46, 3,000 shares. Okay, let's stop here and analyze what happened. Let's stop here and analyze what happened. So an active seller, so call this, a market order is also called an active or an aggressive order. Okay. But these are the limit orders. An aggressive seller came and sold. Okay, so he sell at 50, then he sell at 48, then he sell at 46. Okay, because it was dropping, right? He finished from the 50. Okay, the 50 got what he want. The other one got, this one got part of what he want. Okay, on the chart now we're gonna see that it started at $50 and dropped to $46. Okay. This is basically what you're gonna see. Okay, and now the level 1 will be updated. It's gonna be $46, 3,000 over here, and it's gonna be 51, one here. Okay? It dates to show you the best price to buy or to sell. Now see guys, here the selling, it made the price drop from 50 to 46. So what do we conclude? We conclude that selling will actually make the price go down. Okay. Now see participant 10 what he's gonna do. Participant 10 want to buy at 53 dollars 5,000 shares. Okay, that. So he want to buy and he is a limit order. But as we see here, he want to buy at 3. We have 51, 52, 55. Tab. He want to buy at 53. He will be, if he is at 51, no, he will be happy. So he will be filled, his order will be processed here. Why? Because he want to buy at 53, but here he have the opportunity to buy at 51. So the broker will process his order. Okay. What will happen? Here he wants 5,000 and here 1,000 is gone. So this is good. Okay. Now here what? He still needs 4,000 at 53. And here we have 2,000 at 52. So they are gone. You still need 2,000. So it's going to be $53 here and 2,000. Why I wrote it down? Oops, sorry, I should write it up actually because it's the high. $3. He still needs 2,000 shares. Why did I write it up? Why did I write it here? It's because first we sold for the 51, therefore the 52. Okay, if we're gonna continue, we are buying. We bought from the 51 at $51. We bought at $52. If we're gonna continue, we're gonna buy at the $55. But this person won't buy at the 53. We can't give him, we can't make him pay more. So we stop over here and we put his order here. Okay. Now again, the level 1 will update 53, 2,000 shares. And over here it will be 55, $55, 5,000 shares. So what do we notice, guys? We noticed when we bought, the price changed or went up from 51 to 55. Okay, so what does this mean? What we can conclude here? We conclude that buying takes the price up. And we also conclude that selling takes the price down. So this is basically the only reason why prices move. Okay, not news doesn't make prices move, guys. News affects these people who change their orders and the price is affected. But if you went and find a news on a news provider that nobody looks at, okay, that news won't affect the market because nobody seen it. Okay, and nobody will be affected. The prices won't be, the price orders won't be affected by it. So this is the main conclusion that I want you today to understand, is that the prices move only based on people's order and not something else. Only on people's order. Okay. Okay, so this is the main point. Now, another note about the level 1. The level 1, as we said, shows you the best price to sell and the best price to buy. Okay. As we see here, if I want to buy, guys, I buy from the selling because I'm a buyer, so I have to go to a seller to buy. I can buy at 55, and if I want to sell, I can sell at 53. So imagine, guys, that you bought at 55 now, and in the same way, in the same second, okay, you sold. So you bought at 55, in the same second you say, you should have been bought this, and you sell it. You're gonna sell it at 53. So what? So you lose $2 over here. Okay, again, 55, in the same second you wanted to sell, but the buyers at 50 want to sell at higher. Nobody want to buy at higher. So you are obliged to sell at 50, using $2. And this is the difference between these two is called the spread. So the spread here is 55 minus 53, it's $2. Okay, which means the spread, if you buy and sell now in the same second, you're gonna lose the spread, which is $2. So that's why you gotta think twice before before buying something, because if you bought something and you want to sell it right away, you're gonna lose the spread. And that's why I get many questions that this at this price, but it's showing that will be able to have profit when it reach a higher price. That's because of the spread, guys. Okay, that's because of the spread. Okay, so this is basically
Marwan,
yes.
so it cut off. Were you explaining something? Please, can you repeat the last like 5-10 seconds?
Yes, sure. Okay. Okay, guys, what I was explaining, what I want, I'm gonna buy from a seller. So I buy at $55. If I want to sell at the same second, I'm gonna sell at 53. So if I bought at 55 and sold at 53 at the same second, I've lost $2, which is the spread. Okay. So this is basically what I wanted to explain. And for the, I think I saw a question about negative spread. I don't know. You can't find a negative spread. Okay. Okay. But yes, you can view the spread on any platform. They put for you the buy price, the sell price, and the spread in between. So you know that if you bought something now, you're gonna wait for the spread to go up. Okay, so, sorry, for the price to go up more than the spread in order to start to be profitable. Okay. And yes, don't forget also the commissions. If there is, let me see if any questions. How is the main
Marwan,
seller
someone asked
selling
you
at,
if the main seller, yeah.
yeah, how is the main selling at 55 if you can only sell at 53? I didn't get the answer, but let me explain. So a person here want to sell at 55, and if I want to, I have to go to the seller. So I have to go and buy it at 55. If I want to sell now, I go to the buyer because I want to sell to a buyer. I won't sell to a seller. I will sell to someone who's gonna buy, the opposite. Okay. So if I bought at $55 from a seller and then I want to sell for a buyer, the buyer want to buy at 53, doesn't want to buy at 55. That's why there is a spread. Okay. Is that clear? Okay. Okay. So basically my part, guys. The main conclusion is that when you buy, the prices go up, as we saw, and when you sell, the prices go down. This is the main thing. This is the, I know this is like very basic, okay, but everything that you're gonna learn in the next series of workshops or in your life later on about stock trading, if you don't know this, you will never make money out of stock trading. This is very basic and it's very important. And I spend hours teaching my students this and make sure they understand it before we go further, okay? Because this is very important, extremely important, okay? So thank you, guys. Now we're gonna go back to Aaron. And guys, also, if you have any questions, we can ask at the end of this lecture, for sure. Okay, Aaron, you can go for it.
Yes, of course. So again, Marwan's part was a bit too complicated. It was one of the hardest parts actually. And prices basically they move through supply and demand with factors affecting supply and demand, especially news. You got to follow the news a lot to see it. Whenever a lot of buying power is happening, prices end up going up, and whenever selling is a lot, prices end up going down because supply and demand are changing. So when there's a lot of buying, demand is increasing, so price increases, and the opposite for for selling. So whenever you buy an object, it will make it less available in the market. So all else equal, demand will make its price go higher. And on the other hand, again, whenever a lot of people are throwing away the same thing, so they're selling it, the supply is going to be much higher, so its price is going to drop. So a lot of people were asking us about what brokers and platforms there are to get trading or at least get started, not even with real money. So I compiled a list and Marwan helped us out a lot with that, and I'll be explaining some of the most important and famous ones. So first of all, we have Interactive Brokers. It's one of the best platforms in the world. It's accessible to Lebanese people, which is a good thing because not a lot of brokers are accessible to us. It supports over 134 markets and 33 countries, so that's a lot of asset classes. You can open up an account anytime by transferring fresh dollars from a Lebanese bank. There's a bit of a commission. I'll get into that later. And it's very customizable. It's very high, it's sophisticated. It's not your very simple platform. It's not exactly simple, but you get to learn and you can pick your own ECNs. So this is something that Marwan will actually be explaining. He's more familiar with it. And IBKR, like the Interactive Brokers itself, is a stock that's traded on NASDAQ, which is sort of cool. So these are some of the asset types that you can trade. You have your treasury bills, which are US short-term bonds. You have your bonds, including corporate and municipal. You have Forex, which is foreign exchange. You have your metals. You have your options of all types, like futures, options on futures, options, stock options, mutual funds, futures, structured products, whatever, stocks, warrants. We all explained these last time. They're the basic asset classes. You have Binance for people who are super interested in crypto. It's one of the cheapest ways to get into cryptocurrencies. So Interactive Brokers doesn't actually have cryptocurrency to be traded. But if you want to get into crypto a lot, you can use Binance. Again, it's the same thing. You have to pay with fresh USD to open up an account. It has a lot of lower fees compared to other crypto traders, and it has over 35 currencies, and it's very accessible. It's accessible in over 180 countries. Now, for anyone who wants to trade without actually putting in real money, I'd recommend Webull. It's a zero commission trading platform and it has free live prices. So a lot of these brokers, they actually show you prices that are sort of lagging. So it's not the exact market price at the exact second. Whereas Webull has a better price showing method. Sometimes you have to pay money for that, but Webull's free. Light Interactive Brokers, no. Light Interactive Brokers is a zero commission version of Interactive Brokers, but it doesn't have live prices and its execution is much simpler. Okay, so we'll explain that in later. Robinhood is only available in America. I'll get into that. It's the next upcoming slide. So Webull is amazing for people who want to actually paper trade and learn, and it can be used in the US, India, Brazil, Turkey, Philippines, Malaysia, Japan, China, and Korea. So it's a bit more widespread than your Robinhood, which is only focused on America. So Robinhood is very cheap. It's accessible only to US citizens. So if anyone has a US green card or a citizenship, they're free to open up Robinhood. It's very easy to use. It has no inactivity fees. So Interactive Brokers charges you $20 if you don't do trades for a month. It's just a maintenance fee. Robinhood has no maintenance fees, no commissions, no nothing. But the only problem with Robinhood is sometimes they play around with bit with the spreads. So as Marwan was explaining, you saw the 53 and 55. So Robinhood starts charging sellers more, sellers less, and buyers more. So they make even more money off the spread. That's because they sell their order flow. So they sell everything to another person who actually executes the orders, who actually does the orders. And it's not the most recommended for people who are active day traders because the prices are usually lagging and things like that. Canadian alternative to Robinhood is Wealthsimple. I know a lot of you people are Canadian citizens, so I throw that in. And some other common brokers include Trading 212. It's mostly contracts for difference. It's not stocks. TD Ameritrade or Thinkorswim, that's a very popular platform, especially in US. You have Fidelity, you have M1, you have Questrade, and Coinbase. Coinbase is actually one of the biggest cryptocurrency traders. So thank you a lot for attending. I have just one more thing I'd like to share with you guys. And it's going to be a list that I'm actually going to sell. So just I'm actually going to send it to you guys through the email. Just give me 1 second to find it. So very quickly going over it, this is basically a list we compiled of some very famous brokers. You have your, you have a lot of brokers here, some information on that. Most of them are US centric, which is a problem. Interactive Brokers is the only like fully dedicated Lebanese one. You have a lot of screeners, like tools where you can actually screen and search for stocks, FinViz, TradingView. You have news providers. Each one depends on if they're free or not. We put a nice list. You have your charting tools, which Marwan will explain a lot more in the upcoming session, which is going to be a very heavy session. It's going to be on technical analysis. And you have some other brokers like Robinhood, IQ Option, eToro, eTrade, Charles Schwab, Webull, and whatever. And some of the reasons that we won't recommend it as much as the others. So Robinhood, again, it has lagging execution. That's because it doesn't show you the actual amounts. And as for the commissions, each broker has its own different commissions. We put ones for the most like important ones here. So Interactive Brokers charges you $0.0005 per stock. So $1 if it's less than 200 stocks. So minimum fee is $1. Questrade's $5 per trade, and then you have Fidelity and Fortrade, which are free. So yeah, Interactive Brokers again is the only one that's accessible to us Lebanese people. So I hope you enjoyed the meeting. It was a pretty tough meeting, and if you have any questions, please feel free. I'll be sending you the list of this, the Excel file with the recording. So please, the floor is open for questions, and if you want to ask anything, please feel free.
Yes, Michelle, you can unmute yourself. One moment.
Someone asked me what do I advise to start with as a platform. If you don't want to start with real money, Webull's the perfect way to do it. It allows you to open like a free paper trading account. Paper trading is like trading on paper. You're not actually putting your real money. And it's one of the easiest ones to use. So Webull, for anyone who wants to get into trading without putting real money. Yeah, Lebanese can open Webull, a paper account, yes, but real account, no. It's only accessible in like US, Brazil, and some other countries.
Hi guys, I'll go ahead with
Coinbase is not available in Lebanon. It's only available in like 35 countries. Most of them are Europe and obviously America and Canada. I don't know about Kraken enough. I'll look into it and I'll tell you. But the only one to my knowledge is Binance. If someone wants to unmute themselves and ask a question, please feel free.
Yeah, I'll go ahead with my question. You said for Interactive Brokers, $0.005 per stock, if less than, if above 200 stocks, right?
No, it's basically they take $1 if it doesn't pass 200 stocks. So 200 times 0.005 gives you $1. So everything less than 200 stocks is considered $1. They charge a minimum of $1. That's basically it.
So what if I'm buying one of those penny stocks, like I'm buying 50,000 shares? Will I be charged $250 for that transaction? You know, those shares are very cheap, the penny stocks.
It depends. See, the stock fees are for the US stocks. So it depends on each region and on each platform. So the fee we put actually was for the NYSE and the NASDAQ. As for like OTC, you know, your over the counters, it's a different sort of commission.
Okay, thank you. Understood.
We don't really advise you guys going into penny stocks because they're extremely risky and you never know what you can happen. You have to do a lot of research and be on the right side. So it's a lot of more risk.
Right. Understood.
Unless you have
Thank
a
you.
strategy.
Yeah, unless
Yeah,
again, you have a strategy or you know what you're doing.
exit
These stocks are
plan.
very hard.
True. All right. Thanks, guys.
So if anyone actually
Guys,
doesn't
I
have
have
any
one
more
more question.
questions, please, yeah, of course, feel free.
Sorry, one last question. Do you have
No, I was gonna tell you guys to open up your cameras and take a picture, like if you wanted to, but please go ahead with your question.
Sure. I'm not really prepared for a video, but I'll just go ahead with my question. Do you have an answer to why all shares are crashing right now? Is it that something to do with the yielding of the bonds and interest rates? Do you have an explanation on that?
So basically, what we're witnessing right now is money moving from stocks towards like safer things, if you want, things like gold and whatever. So that money is actually going out of the market more than it's coming in right now. And that's due to a lot of macroeconomic factors. Obviously, we're like in a pandemic, not everything is recovering 100%. So it's going to be a pretty choppy market, you know? And things happen all the time, especially like a lot of like tech companies, they're valued super high. So those are the ones that are actually getting beat up the most. Whereas you see a lot of like value stocks, they're not doing as bad.
Yeah, look, you can also know that the market is overvalued. You can view that if you type on Google Schiller PE, you're gonna uh, you're gonna find that Schiller PE is very high. Okay, what is the Schiller PE? Now it's something quite complicated, but basically it shows you the price per earnings for all the companies. Okay, so if you look at the chart, you see at every top, okay, you have like a market crash, and now we are actually at the top. Okay, so we knew that we're gonna see a market crash like 2 weeks before from the Schiller PE, because now it's historically very high. Okay, so just type on Google Schiller PE and click at the first link you're gonna find on Google, and you're gonna see like a chart for Schiller PE, and you're gonna see that now it's very high historically compared to the past. And you can also see in the graph that whenever you have like a top, you have a very strong crash, like the crash of 2008 and the Black Tuesday and the Black Saturday, I think, or Black Monday.
Again, but we don't mean that right now we expect the market to crash. Everyone has a different way of detecting. Some people are like, no, this is the bottom, we'll buy, and they might be right. So there's no 100% accurate way to know if a crash is coming or not. We have some sort of indicators, but they also are hit and miss.
It already تقريبا crashed. But هلا
But like this is so far we're in correction territory, which is less severe than a crash. And a correction is something that happens a lot. You're going to see it a lot. So it's sort of a healthy thing that happens in markets. But as for crash, I'm not sure. We don't know. Marwan seems to think that the crash is coming. And yeah, he might be right. Like no one knows. That's what we're trying to say.
So this is a bit personal. I suffered some loss on the shares that I bought, around maybe 20% of my portfolio. Do you think I should exit now? And okay, I know Aaron said we cannot predict it, and Marwan was saying from his point of view it feels like a crash. What do you think if you were me? What do you think you would do? Would you hold on it and wait for it to
sorry,
get
بس
better?
قد your portfolio, how much?
Around 20% of my portfolio, and my portfolio consists of mostly some tech and some You know,
Yeah.
batteries for the electric cars and some electric car companies. A collection of these sort of companies.
Something will help you is the workshop of the fourth workshop that we'll do, which is about risk management. You should watch it because, and not you only, so for all, you should watch that because it will save you from a scenario like this, which is losing 20% of your portfolio. So you better watch that. Now, if I can't tell you to sell now or to buy now, because like even if I'm 80 or 90% sure that the other 10% might happen.
Correct.
Like try putting some stop losses for sure, just in case. If you wait for the fourth lecture, you're gonna understand more like what to do. Okay.
Yeah. All right. Thanks, guys.
You're
Thanks,
welcome.
Marwan.
Is the Schiller P a universal factor? Is it only for the SPY? I don't remember, to be honest.
No, it is. It is only US centric, actually. It is.
all
Global
the
markets move completely differently. No, the Schiller P ratio is always corresponding to the S&P 500.
yeah, only the SP 500 مش the all stocks of US.
No, maybe, I don't know, India's doing amazing right now and they somehow figured like a cure for Corona and everything's open. No, ما خص أبداً. So
yeah,
the
yeah,
Schiller
Schiller
P
P
only
أكيد
is used
it's
for the
just
US
for the
market.
US. Yeah, Schiller P is only for the US, but اللي عم بسأله إنه is it just for the companies of SPY or which is the SP 500 or
No,
all
it
the
is. It
companies?
is only for the S&P 500.
Yeah,
It
yeah,
correlates with the S&P 500, though. Not even like the Nasdaq or the NYSE. No, just specifically for the SPY.
Yep.
Do you have any other questions, like even questions from last time or questions that passed like today or in the quiz? Seriously, anything. We're here till like 6:30 to answer everything. It doesn't have to be like 100% related to the topic we talked about today. Just questions in general. We're more than happy to address any concerns. Adnan Abu Isa said how to start. What do you mean how to start? How to start like trading and investing? You can start first of all by reading a lot, by understanding the market conditions right now. And then if you want to actually put like fake money, you just go ahead to Webull, open up your paper trading account, and you can start at any time.
Yeah, I have like an advice for you for all people who want to start new. Before you start, you have first to learn everything about like concepts, theories, everything. Okay. And you have to learn risk management, Listen, guys, the profitable trader is three things. Is strategies. So you have to have a very strong strategies. You have to have a very strong risk management and money management rules. And you have to have trading psychology, which is basically controlling your emotions. So these three, if only one factor is gone, you're gonna be a gambler. Okay. So you have to learn these three. Now, the strategies and risk and money management, you can learn these through researching, maybe through my courses that I give. I teach these. Now, بيبقى field trading psychology. For the trading psychology, you start with like a small amount of money, of real money. بس أكيد قبل you start trading with fake money in order to strengthen your strategies and risk management skills. من بعد, after you strengthen these two, what I advise is that you put a small amount of money just to practice on controlling your emotions, because if you can't control your emotions, you won't follow your strategies and your risk money management rules, which will make you a gambler. Okay, and you don't want that. So the next step after fake paper trading, we call it, is trading with a small amount of money. And after that, when you feel comfortable, okay, when you feel that you can control your fear and you can control your greed, because these are basically the two emotions. It's fear and the greed that plays when you stock trade. You put the amount of money that you want you put, okay? this what I advise. This is what I did, what I advise my students to do, and what I advise you to do. And also let me put my phone number if someone want to contact me about something, about my courses, about anything. So this is my phone number in the chat box. لك books هلا في كتير books okay بس to be honest I don't يعني for sure go read books okay but it's not everything okay if you're studying physics engineering biology it's good to go and read books but everything which is related to business and finance and trading nothing can really benefit you other than working with it okay. So هلا في books I think interesting investors but it's very hard so you have to know a basic information.
Yeah, books are mostly for like investing. If you want to like be a day
Yes,
trader and work
true.
daily, we can't recommend
Yeah.
any books. But for investing, if you want to talk to me private, I'll give you a couple of things to start with.
Yeah, but as Aaron said, for day trading, if you want to day trade every day, you need to work with it or take my courses. Actually, I teach day trading. I don't teach investing. Buying stocks in Lebanon. First, you're gonna find a broker that you want. لنقول you want interactive brokers. You have to open an account. هلا to send them money you have to يكون معك cash dollar. To give it to the bank, they give you a card, I think, which is fresh dollar, and you can transact money to your account in interactive brokers, for example, or any broker, and you can start trading stocks. Anytime.
For the step-by-step process, right now it works like basically you open up an account through Interactive Brokers because it's like the only one that accepts Lebanese citizens, and then you go to like your bank, you open up a fresh USD account, you deposit some, whatever money you want to open the account with. Then on Interactive Brokers, they're gonna ask you to like send a couple of things like بدك تحط الهوية أو driver's license أو بعدين بيسألوك like residency so بدك تحط موقع بيتك وهيك أشياء. So بيطلبوا منك كم document وبعدين بيطلع لك approval وفيك تحول المصاري basically.
Yeah, and one important note for the people who want to do shorting, okay? في بس تعملوا الابليكيشن when you do the application on interactive brokers, you're gonna see account type. So you have to choose the account type. There is a regular cash account and there is a margin account. If you want to short, you have to use the margin account, okay? In the regular cash, you can only buy, okay? And even you can't if you want to do leverages, okay, which we will talk about them later, you also need a margin account. I don't advise you because chart patterns are like entry points, okay? They are not strategies. هلا I know guys what you see on YouTube. When you what you see on YouTube, use this indicator and this pattern and this something, and you're gonna be good. No, it doesn't work like that. You need a strategy. Now, part of the strategy have something related to chart patterns, which is only locate for you the best point to buy or to short at. Okay, but depending only on chart patterns, you won't make money. Okay, you may make money once, twice, but on the long term, you're gonna lose. Okay, without a strategy, to be honest, you won't be able to do it. Anytime.
So Marwan's next session is going to be about technical analysis, which is going to be all about candle patterns and candlesticks. And yeah, we'll teach you some of the basics. Marwan will.
And you're gonna like it a lot, believe me. It's the best. All my students, it's the favorite chapter is technical analysis. So you're gonna like it a lot.
Thanks everyone for attending the workshop. We hope you enjoyed it. I think we're gonna wrap it up now. Hopefully we'll have the next session next Friday around the same time. We'll keep you posted. We'll send the recording and we'll send you an email to confirm. Thanks a lot.
Thank you guys. See you next Friday.
Thank you so much for attending. See you next week.